Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Long Verticals and Diagonals. And with the S&P teasing within a fraction of a percentage point of all-time highs, I know that bullish strategies are on the minds of a lot of traders out there. So what we're going to be talking through today are 5 key steps for trading long call vertical spreads. I'm really looking forward to this discussion. We're going to be outlining an example vertical spread, going through those 5 key steps on the Thinkorswim desktop platform. Before we get to any of that, though, let me first of all say hello to everybody that's chatting out there on YouTube. Great to see so many familiar names, as always. Hello there, David and Ted, Rick, Will, Sharon, Life in the Fast Lane, Josh, Bush 8531, William, and everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions in these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the show, but be aware that you're invited to join us in the live webcast. If you'd like to be here in our live stream audience, this is a Thursday webcast series. We kick things off promptly at 11 Eastern. We would really like to have you here in the live stream audience if you'd like to join us. And as a special treat always for our live stream audience, we have a coach writing alongside me in the chats. And today, that's Brent Moore, is a very good friend of mine. Brent and I have been working together for more than 20 years. Brent brings a ton of experience to this discussion. So thanks for having my back there, Brent. And Brent is also can be contacted, best place to connect with your favorite presenters is if you have an account on X. Give us a follow there on X. You can find Brent there at Brent Moore's CS. You can find me on X at Cameron May CS. All right, but let's get into this discussion. 5 steps for trading long call vertical spreads. As we do, of course, we need to first of all consider the risks associated with trading. Certainly applies to options, so bear these disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular strategy or security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay, so we have 45 minutes ahead of us of learning. Let's talk about what we're going to be talking about. First thing that we're going to be doing is look at our existing example trades in our paper money portfolio, see if any of those needed attention, and I think at least a couple of them do. Then we're going to take a quick glance at the markets. I've already told you, the S&P 500 trading right up there near all-time highs. We'll see if it can push through and actually accomplish the feat. We're going to be putting ourselves in the shoes of a trader who thinks it is, and then we're going to spend the bulk of our time talking about those 5 steps for planning and placing, executing a long call vertical spread. Okay, so let's go right to the Thinkorswim desktop trading software platform, have a look at our current positions. And hello there, Dave and Bill, Mighty Mouse, Waranini, Kate, I Never Eat Here, Josh, welcome. Great to see again so many familiar names. But here are our 4 current positions in our long verticals and diagonals portfolio. 3 are doing great. That one, this is the one that we're sticking with for the entire year. It's not been a good year for that one. But let's start with Broadcom here. So with Broadcom, we have a 230, 240 long call vertical spread. Hey, what do you know? Going to be the topic today as well. We're in 5 contracts. We took this position just 2 weeks ago. This was the last webcast we did in this series. Last week was a holiday, so we're coming back to have a look at this. Now, with this trade, with a 230, 240 long call vertical, we'd like to be above 240, and the stock is well above 240, so this trade is doing quite well. We paid a net $7.85 to get into this position, hoping to see it increase on a $10 wide spread. That gives us our maximum theoretical value here of $10. Bought it for $7.85, hoping to see it increase to 10. Guys, it's pretty close. It's within about 30 cents. Look at that spread is almost $10. In 2 weeks, we thought this was going to take 5 weeks. There's still 22 days left on this contract. On these contracts, if we want to look at this on the chart, here was our entry right here. We kind of waffled sideways for a while, but yeah, Broadcom is really taking off. That's really assisting this trade toward its maximum gain. We're not at maximum gain yet, but we're most of the way there already, even though we're only on week 2, entering week 3 of 5. So what do we do? Should we wait through July 18th to see if we can get the other 75 cents or whatever's left in this trade as its theoretical maximum potential? I think with this one, what a trader might do when a trade is going well, obviously they could just leave it alone. Looks like we're solidly above 240. We're way up here. As we approach expiration, as long as we're still above 240, we should be in position to make the rest of that potential profit. However, we could collapse down, give some of those profits back, maybe enter into loss territory. What might you do if you're managing a similar trade in your paper money portfolio? This is where some learning can happen. Well, one of the options available to us is to exit some of the position. Martin's saying, hey, let's close it, take some profit. I'm going to do that, Martin, but I'm not going to take all of it. Okay. What we'll do is, since we're in 5 contracts, how about I'm going to take most of it. Let's right click on our AVGO. Let's create a closing order to sell out of these verticals. By default, it's going to get an order ready to sell us out of all 5, but I'm going to dial this down to just 3 of the 5. Let's leave 2 in action so that we can continue to learn from those. See that there still is profit potential. It looks like we might be able to get out for $9.32-ish. I don't know. The natural is actually down toward $8.95. So if we're in for $7.85, even if we got out for like $9, if we sold for $9 after entering for $7.85, that'd be $1.15 profit. That would be leaving $1. Instead of exiting for 10, we're exiting for 9, leaving $1 on the table. How about we do that? That would be about a little bit more than half of our maximum theoretical gain on this trade. Let's click confirm and send. Now we might be able to sell for more than this. I'm just saying this is the lowest amount that we would accept to exit. That's our limit order. There's a risk that our order might not fill at all. If it does, there is a commission to be paid here. CS says exit the call component. Actually, both sides are a call component. I think you might be talking about exit the short call component, maybe. Could we exit one side or the other, one leg or the other? We could. Now that changes the remaining contract. It changes the risk reward scenario dramatically. So we'd have to be aware of that. Ted says, do you not use a walk limit order because you are on paper? Ted, that's a good idea to maybe cover in a future webcast. Maybe we'll put that into a future discussion, because that walk limit order was just introduced not too long ago. I actually made a video about that. But for now, let's just do a traditional limit order. Let's see if we can get out for $9. Let's send this order off to sell out of 3 of these verticals. Send that order off and let's let that work. Oh, looks like we sold out at $9.35. All right, good. That is now a realized gain, setting commissions aside, of $1.50. $1.50 when we were in for $7.85, that left us a maximum theoretical gain of $2.15. Yeah, we got basically 2/3 of the maximum gain on those 3 contracts. Let's see how we can do on the remaining 2. So now let's have a look at our GILD, our Gilead Sciences position. So we have 3 contracts working at the moment. With this, we bought some long calls, the $95 long calls, some time ago. Those have 721 days till expiration. This one we sold the 120 short calls, and this one's actually been going for a little while. Let's revisit the history of this Gilead position. So back here in January, we bought that $95 long call with the hope the price would go up, and it did. Now, it actually shot up dramatically. What that caused us to have happen is that we were in and out of a couple of short positions at a loss here. As it was going up so rapidly, those short positions didn't do so well. Now, since then, we've stacked on some profits. Right now, we're in a short call. Look at where that is relative to where price is right now. That 120 short call way up here expires on July 18th. Price has fallen back. It's retreated from that level. And that's caused that short call. So this is a long call diagonal spread. That short call still has 22 days left on it, but it is way out of the money. There's only 21 cents of value there. We sold this for 223. We're just at 90% of the maximum theoretical reward of this short call. I think what we're going to be doing is getting out of this short call position, maybe roll it down. I think this is what I was considering doing today. Tell me if you think this is a crazy idea. What are the pros and the cons? That's what we'll think about. I'm going to roll this down to right here. I'm going to stick with the same expiration, though. Interestingly, when we think about rolling, very commonly, the trader might think, well, am I not rolling to a higher probability? Am I not rolling further out in time? Not always. We don't always have to go out to a more distant expiration, and we don't always have to dial up the probability. Sometimes the emphasis might be on creating more credit for the trade. So we just saw this short call so far out of the money, it's only worth 21 cents. Maybe what we could do is sell another call a little bit closer to the current price, closer to at the money. That's going to carry a larger premium, but still with a low probability of actual assignment. Let's go to the trade tab and see what we might be able to get. Sticking with the 18th of July, you can see we have a position for the 18th of July. It's right there, and that contract's worth somewhere between 12 and 25 cents. Well, if we look at the 115 for the same expiration, it's worth somewhere between about 70 and 80 cents. So let's say we were able to exit this one for 25 cents, get into 115 for 75 cents, just for argument's sake. That might be done at a 50-cent credit, increase the future profitability potential by 50 cents. Doesn't sound like a lot, but this was only a $15 contract. The long was only 15 bucks in the first place. So still not an insignificant amount. So increase the probability of reward, but what's the trade-off? Well, now, instead of agreeing that someone can buy shares from us for 120, someone would have the right to buy shares from us for 115. Yeah. It's still not a high probability of assignment. You can see our delta here, which can tell us, how much the contract might make or lose if the stock moves up or down a dollar, but it also can tell us the likelihood of the contract ultimately expiring in the money and being assigned at expiration. Only about an 18% likelihood of that. Yeah. Isaiah says, does TOS automatically pair them as a diagonal trade of close out of the short call? It depends on how we enter the order, Isaiah. But yeah, let me show you that. So let's do that. That's going to be our plan. Close out this 120 for somewhere on the order, maybe 20, 25 cents. Let's see if we can sell that new call for somewhere between 70 and 80 cents. Let's go to our monitor tab. There's our 120 call. I'm going to right click on that and create a rolling order. Now this is going to call this initially a calendar. Calendar just means we're dealing with two options of different expirations. But first thing that we need to do is tell this one, this is the order to buy out of the one that we already are in. We need to tell it, hey, we're actually going to sell the same expiration, 18th of July, but not the same strike. We're going to go to 115. That looks like it might be a 54-cent credit. Let's say we're willing to accept a 50-cent credit in whatever combination, whether we have to, whether we can get out of the one that we're closing a little bit less expensively or collect a larger premium or whatever. We're shooting for at least a 50-cent credit here. All right, so let's confirm and send this order. We're going to sell this now. Notice it's describing it as a vertical. It's not actually a vertical. This is one position to close, another one to open. But this is in order to get out of the 120 into the 115 for a credit of at least 50 cents. There would be a commission here to be considered as well. So that would leave us with a net credit across three contracts of $146. $50 times 3 is 150 minus the 390 gives us that 146.10. So let's send that off. All right, and we sold into that position for 53-cent credit. So we've closed out the 120 into the 115. I'll map that out on our chart for our next discussion, but just know that instead of now having an obligation to potentially sell shares for 120, we have an obligation to potentially sell shares for 115. All right. So we manage those two positions. The other two, I think we're going to just leave as they are, just as a spoiler alert. But what are they? Well, with Google, we have a long call a long call vertical spread again. 6 contracts on both sides. We prefer for the stock to be above 165. It is above 165. It's at 172. So if we look at that on a chart, here's how things are working. We entered the trade here, started off well, surrendered some significant territory. We actually poked down into the spread for a moment here a week ago, and then we've started a rally. So we're back up in our green zone. We'd like to be above 165. Now, always be aware that even though these short contracts, these are out of the money, there's still risk of assignment. Now, if we got assigned, it's actually the desired outcome in the case of a long call. Someone buys shares from us for 165, we could then, if the trader wanted to, exercise their right to buy shares for 160. Buy shares for 160, sell them for 165. That is a realized maximum theoretical gain. We're not there yet, though. This trade's doing just fine. I'm going to let that one work. You can see it's up about $400 at the moment. Here's the one that's been tripping us up for the year. This is a long call diagonal spread. We just bought one contract of the 520 calls back on January 9th, but we paid up for those things, spent 10 grand. And those have been, look at the loss here. Ouch. Can you say ouch? So the question is going to come up just about every time I show this trade. Cameron, why are you even in this? Well, on January 9th, when we took this position, the premise here was let's take a trade, put ourselves in the shoes of a trader who just says, I'm sticking with this no matter what comes. That was the premise. So here's what can happen. So we're just trying to deal with, make the best of a bad situation, really. So let me show you the history of this trade, because there is an extensive history at this point. We're 6 months into the end of the year. Let's bring up UNH. Right back here is where we bought that call, and it went sideways, started to get some momentum, and man, big gap down on a negative earnings announcement. I took a break and went on an extended vacation here, and while I had my back turned, it just kept going. But here's what's been happening with this trade. It's not all bad news. Yep, we paid up for that long call. It's really taken some damage. But along the way, we have made some profits from some short calls as we diagonalized this diagonal spread. $8.60 realized here, $6.72 realized here, $3.70 realized here, $5.30 realized there. Those are all realized gains. Right now, we have an unrealized gain on our current short call. It's working its way right toward maximum gain. I think I'm just going to let it go there. There's still a possibility the stock could rally. So we're in a short call that expires on the 18th of July. Could UNH conceivably pop up from $305 to $530 in the next 22 days? Could. There's almost zero chance. There's not zero chance. There's almost zero chance of that happening. So I'm going to leave this one on. It still has a little bit of meat left on the bone. There's our 530 short call. Sold it for $315. It's worth 16 cents. I think I'm just going to allow this one to expire worthless. I don't think we've done that yet in this series. So we just want to kind of go through that experience. There's still a very, very remote chance that it doesn't expire worthless. But look, it's pointing in that direction. Okay, so probably another $315. That's most likely to be a realized gain here in a few weeks. So we'll let that work. So those are our current positions. Naresh says earnings might help. It could. Naresh, earnings are definitely a consideration. We're going to be talking about that today. But let's plan and place a new long call vertical spread. Now, why are we doing a long call vertical spread versus a long put vertical spread? Well, for some traders, they look at market conditions first, and that might dictate to them whether they're considering bullish or bearish trades. What's been going on with the markets? Well, we had that 22% sell-off in the S&P 500. And if we can just get, I think it's about 0.15%, literally an eighth of a percentage point or a seventh of a percentage point higher from here, that would be a full recovery of this bear market. That'd be the fastest bear market correction in history. The fastest one being the one coming out of COVID. That one took 4 months. Right now we're about 2.5 months into this recovery, maybe coming up close on 3. But let's just say that our trader just sees prices going higher, and so they're primarily trading bullishly. Now, things could turn on a dime. Could we bump our heads right here as resistance and go right on down? We could, but let's assume that our trader here is looking out into what they might consider the foreseeable future when it comes to stocks and price movement. That's a big gray area, right? But let's just say they think things are likely to continue to climb, maybe pushing through these record highs. Maybe that could spur even more explosive growth. Who knows? But let's plan a bullish trade. We're going to be placing a bull call vertical spread, but I want to walk through 5 steps that might help a trader accomplish that. So I'm going to outline those 5 steps right over here. Okay. And let's just outline them first, and then I'll give you the details of what I'm talking about. Number 1, we're going to do something called the setup. Number 2 is going to be strikes selection. 3 is going to be expiration selection. Number 4, and actually 2 and 3, pretty interchangeable. As a matter of fact, for some, they might just, let's do those in an opposite. Let's do expiration and strikes. Okay. Number 4, we're going to assess the reward and risk scenario and make sure that we're comfortable with each. And then finally, we're going to be talking about the management of the trade, whether it's doing well or doing poorly. Everybody here says, I guess no one got hurt taking a profit, right? Well, it can sting really badly if we take a bunch of small profits and then while we're waiting around on one that hasn't been profitable yet, we take a huge loss. There are risks even with that concept. Yeah. But let's walk through these 5 potential steps. Some might consider them key steps when trading, planning, and placing a long call vertical spread. And our example stock today, we're going to use Amazon. And you might say, well, how come Amazon? Well, this relates to step number 1. When I mention the setup, I'm talking about what does a technical trader see on a chart. Now, not every options trader uses charts. It's been my experience. I think I can comfortably say this, that most do. I might be wrong though. But in any case, there might be some pre-qualifiers before even getting to the chart. For some, of course, price per share of the stock, the liquidity of the options can be a consideration. But what is meant by the setup? Well, this is the trader first confirming that they think the stock chart looks like it's bullish. So how might they do that? Well, there could be a number of technical ways to assess the bullish outlook or maybe the bearish outlook of a chart. So let's just look at this through one potential technical lens. First of all, the trader might want to assess the trend of the stock. Now, they could do that manually, looking at just highs and lows, or some might recruit technical indicators to assist with trend analysis. A common technical indicator is like a simple moving average. So let's do that. Let's come up to our Flask icon. I'm going to type in the simple moving average. Let's add that to our chart. And since we're going to be placing a trade today that not always short term, but tends to be kind of in a shorter term range, let's use kind of a shorter term indicator. So I'm going to choose for today's example a simple moving average length of 20, and let's apply that to our chart. Now, while we're here, that may assist the trader with trend. It might also identify a potential area of support for a bullish trade. Even within a nice trend, a trader might look for highs and lows within a trend, look at the timing within a trend. And to assist with that, let's use a momentum indicator like the MACD. I'm going to choose the MACD histogram as a second example here in our setup. Let's click apply and click OK. All right. So this is just going to be one example system or setup system that some traders might use when planning a bullish trade like a bull call vertical spread. So the first thing is a trader might look to confirm that the trend appears to be bullish. And with a simple moving average, one interpretation of that is that simple moving average rising? You can see it's been rising, in this case, since April. There was another time when it rose for a substantial amount of time back here from August through February with an occasional sideways drift or a little bit of a dip there. All right. So let's say that our trader has in their setup, first a qualifier is that we appear to be in an upward trend. They may also make sure that the price is above that trend line. Being below the trend line may signal maybe some weakness in the chart. Now, this is where even within an apparently upward trending stock, there can be times when it might be comparatively better to get into new bullish trades, and times even within the same trend when it might be comparatively worse to get into that bullish trade. Typically, our trader is looking for getting in closer to a trend line when it appears to be at or near a cyclical low. All right. Now, they could, again, just assess that manually, or this is where our second indicator may assist. So I've applied down here our MACD histogram. So that's what we would look for in our list of studies. If we're trying to add this to our chart, MACD histogram. And there are several different ways that the histogram might be traded. One of which, though, is when our histogram dips down into red. We start to see these bright red histogram bars. That can be an indication that prices had some bearish momentum in the short term. But if it starts to shift from bright red to dark red, for some traders, that could signal, oh, we might be going back to a bullish scenario. That might be seen as not so much selling momentum, the buyers may be starting back in. That's at least the concept here. Now, let's see, Andy says, how do you decide how far back to look on the daily? From April, it looks like it's going up, but from May, it's gone sideways. And from January, it's down. Good question, Andy. Here's what Andy's talking about. From here, it looks down. From here, it looks up. If a trader is struggling with that in doing that through a manual process, maybe that's exactly where they might recruit something that's more mechanical, like a moving average. So yeah, during this time frame, if our 20-day moving average, if that's the moving average our trader is using, they might say, well, it looks bearish. So at this point, they might hit the brakes on any new bullish positions. Then as we get a reverse in that trend, even with the slightest little uptick here, it may change their outlook and they might start looking for bullish trades again. But what might be the more precise timing of those trades? Well, using a momentum oscillator like this, they might look for the momentum shift at lows. Now notice, I have some arrows here to indicate that there appeared to be bullish signals. There isn't one here. What's the difference? Well, for our setup, for our example setup, let's say that our trader is first confirming that our moving average is at least tilted upward. Notice right here, you'll have to squint. Slightest tilt upward. Check. Second, they might look to see that price is above that trend line. That's check, check. Now, third, once they see those two things are in place, then they might look down to our timing or momentum oscillator and see if it has a recent shift from bright red to dark red. And we have that right here. So I have arrows indicating we have a combination of those three in our setup. So there was our signal. And in this case, that one looked like that was a pretty decent signal, especially for someone planning something like a bull call spread. Here's another one. Upward sloping trend line, price above the trend line, recent shift from bright red to dark red. There's a potential entry signal. Now there are a couple here that were a little bit choppier. Depending on the placement of a vertical spread at that time. They likely still worked out, maybe. Leon says, how do you display the up arrows on the chart? So Leon, yeah, good question. I don't mind quickly answering that. You just draw a normal arrow and then right click on it, edit its properties, and you can change which direction it points right there. Okay, that's it. You can change the color as well. But that's it. I just let's remove just that one drawing. Anyway, I changed the orientation, then I saved that on that pop-up as the default. So anytime I draw a new arrow, it's pointing upward. Well, look at what's happening very recently on Amazon. Do we have an upward sloping trend line? Yep. Is price above that trend line? Yep. Pardon me. Do we have a recent shift from bright red to dark red? Has there been an apparent momentum shift signaling we might have a short-term low here? Yes. Now, with all that work done, it's not a guarantee that this trade is going to work out, but there's our setup. Now, a final element of that setup when we're in a bullish trade is to determine, hey, when might this thing break down? How might the trader know, or at least suspect that they're wrong in their timing? Well, it just didn't work out. Well, this is a third element of our setup, is to look for in a bullish trade, where's the recent price floor? Is there a support level somewhere? And it looks like coming off these previous highs, there's a little gap up here, not a little gap, a big gap up over those highs that failed again. It just acted as a price ceiling again. But since then, price floor. So it looks like maybe a support right there around 207-ish. Now that may play a role as we get into management. All right, but there's our setup. Now we need to make some decisions. Let's say that we're going to go ahead with a bullish trade here. Which expiration might we choose? Well, one thing that can assist with that as we look out into the future, well, let me say it more generally, and then we'll get a little bit more specific. Let's see. CS says, Cameron, Amazon has low stock volume. No, I can't agree with that. It's actually one of the most heavily traded securities in the world. So it may appear low because we're only 2 hours into trading today, but on an average basis, there aren't very many stocks out there that get more trading volume than Amazon. All right, but in any case, when trading long call spreads, how do we choose an expiration? Well, for some traders, if they're selecting a spread that's way out of the money, and they might need to give more time for the spread to make the anticipated move. On the other hand, if they're choosing a spread that's, let's say, deeply in the money, maybe they want to minimize the amount of time left on the contract, doesn't get to try to avoid giving the trade time to misbehave. But let's take another consideration, another factor into consideration. That is, there is an earnings announcement around the corner. Looks like there's earnings coming up on the 7th of August. Some traders prefer to just avoid earnings, and if we have that preference, maybe the trader wants to be in and out of the trade before the 7th of August. All right. So a few factors to consider here. As a general rule of thumb, some traders might consider there to be sort of a sweet spot. Going with really short-term vertical spreads can tend to minimize the potential reward of the spread. Doesn't mean it's bad. It just means that if the reward is very small, you could have a large associated risk, and that might not be so good for some traders. Going further out in time might give the trade too much time to misbehave. So for some, they might consider a sweet spot, let's throw that in air quotes, somewhere between 20 and 40, 20 and 50 days. Definitely going to be some differences of opinion there. But let me go to the trade tab and let's select an expiration. And I think what we'll do with earnings coming up August 7th, let's give this trade some time to work. How about we look at the August 1st expiration? That'll have us out of the trade before earnings. It takes it out of the equation. And one thing I'm checking here is with these weekly contracts, there can be a fairly wide spread between bid and ask prices. Doesn't seem to be the case here with these Amazon contracts because it tends to be a highly liquid stock. So let's build our trade there. Let's go for our expiration. of the 1st of August. We have our setup, we have our expiration. Let's choose some strikes. Well, we've done a strike comparison in past presentations. What we need to be aware of is that there's a teeter-totter effect. Reward to risk is a prominent consideration, and it's going to be one that we weigh right here in step 4. But there is a predictable relationship of reward and risk as we go in the money or out of the money. As we go in the money, that increases the probability of success. It causes the reward potential of the trade to go down. So if a trader has a preference for high probability with lower associated reward, they may choose to go in the money with contracts. If they're okay with lower probability of success because they are pursuing high reward potential, they might choose to go out of the money. And what I'm going to do for today's example, we're going to split the difference. We're going to go at the money. With the stock trading at 216, what if we bought the 215 and sold the 220? So that would just mean that our stock would need to get up here above 220 before expiration. So we need to get it. Let's draw in a line here. See where it is right now? In order to be at our maximum gain scenario as we get toward expiration, let's carry this out to August 1st right there. And I'll draw a line down so you can see the intersection there. We need to go from here to up there, be above 220 by expiration for this trade to work out optimally, or to be in position to work out optimally. So that's what we're going to do, 215, 220. So let's look at its reward and risk potential. How can we do that quickly using the option chain right here? I know that we could go to the Analyze tab. I know we could do that. I like my learners. See, it says, Cameron, I thought you were going long on put. Nope. See, this one is a long call spread. If we do a long put spread, that would be a bearish strategy. We're going bullish with this trade, okay? But here's a quick way that we can assess the reward and risk scenario on its spread. Come up here to where it says spread single and change that to vertical. And then we can just look at the spread that we were considering, the 215, 220. Let's weigh how much it might cost us. It's right now between 235 and 270. Let's say that we can get that done for 250. All right, well, 250, if that's the expense of the trade, that's the risk of the trade. That's the maximum theoretical loss of the trade, setting commissions aside, $2.50. If we're spending $2.50 to set up a $5 wide spread, how much does that leave for reward? Well, $5 minus 250 is 250. Yeah, this is a trade where we're risking 250 with the potential to make 250. In other words, we could make 100% if the stock goes up to where we think it's likely to go. We might be wrong. But if it goes up to 220 and is up above there as we get toward expiration, we hit expiration above 220, that's where we'd like to be. On the other hand, if it goes down and instead of going above 220, it falls below 215, and that's where we are at expiration, we could lose 250. Okay? So that's where a trader can do a quick reward risk assessment. How do we know? If you're not terribly familiar with spread trades, it may be useful to understand what could happen here, why reward and risk is realized above and below certain levels. If we're in a 215, 220 long call spread, what we have here is the right to buy shares for 215. Someone else has the right to buy those shares from us for 220. And that's what we want to have happen. We want someone to buy those shares at 220. We buy them at 215. That would be a $5 profit. That happens at expiration, especially if the stock is above 220. If the stock is worth 230, 240, 250, yes, if somebody can buy that from us for 220, it's in their mathematical best interest to do that. So they buy the shares for 220 from us. We buy them for 215. and we make our $5 profit minus the $2.50 cost to set this whole thing up. So right now what we're doing is we've calculated reward. If this thing collapses, if the stock goes down below 215 and we hit expiration, the contracts just expire worthless and we lost our investment. So that's our risk. John says, why do you need to do it in your head or wait till confirm and send? So tedious. John, no, I agree. Yep. I kind of feel like, don't take this personally, anybody, but I feel as an educator, it's my job to make sure that we can do that, because it's like when we were all learning about math. Did they say, hey, everybody, welcome to class. This is math. Here's a calculator. Nope. That sort of stunts the understanding of the topic. Instead, what they did is they said, here, hey, 2 plus 2 is 4. These are the reasons why 2 plus 2 equals 4. And now, by the way, we have a machine that will tell you that. Well, guess what? Thinkorswim has a machine that'll tell you that. We could use the Analyze Risk Profile, and it will do it for us. But I think that stunts the growth of the learner. Someone's out there trading without really understanding because they have a machine that's doing the thinking for them. So that's my logic there, John. I hope that makes sense. So yeah, I try to talk through this. If you're not following along, that means there's still more learning to do. Yep. If you're already following along, this gets tedious, and you say, I'm skipping over to the risk profile. I already understand this stuff. That's perfect. Okay. But one other thing before I go place this trade, actually, and we start the management of the trade, where would this trade break even? How do we calculate the break even without looking to risk profile? Well, if we need to be above 220 at expiration in order to make $2.50 potential profit, that must mean that if we're short of 220, we must not be making 250. So we take 220 minus 250, 217 and a half is our break even point. Yes, I can see all that on the risk profile, but let's get it our ability to calculate that manually first, and then start using those other tools that make life easier. All right, so that's the reward and risk of our trade. Finally, as we place our trade, we might want to have an idea in mind for how we're going to manage it. Well, a couple of things to consider here. So the trade might work out, and it might not. Let's talk about the not so fun. What if our stock falls down below our 207 support? What if it comes down here to, let's say, 205? It's not behaving bullishly, and we don't have a lot of time to sit around to see if it's going to course correct. So maybe the trader might have a plan to exit it somewhere like, below a support level. Let's say that's 205. Now, on the other hand, if it's working out, just as we've seen already in this webcast, well, we could wait to get the maximum reward, or for some traders, they may take even a partial maximum reward. So maybe the trader considers getting out with, let's say, 50%, 75% of our maximum reward. Let's do that. Let's go to our trade. I'm going to come to our spread, right click. I'm going to create a closing order. Let's buy a custom order with the OCO bracket. This is an order to buy. Hold on a second. Let me do this. Let me delete this. Let's do it this way. Go to our 215, 220, click on that, create an order to enter into that vertical spread, change that to a first triggers OCO, and we're going to right click and create an opposite order. This one's to manage our profitable scenario. Right click, create an opposite order. That one's to manage our loss scenario. And we just need to tell it the conditions. So here's one thing. Let's hide this left column now that we've seen the steps. Let's say we'd like to spend a maximum of 250 to get into this trade. Well, if we can get into it for 250, what if we could get out of this? Let's make this one good till canceled, limit order. What if we could sell for 375? That would be $1.25 profit. That would be halfway to the maximum of $5 that we could make. Now, at the same time, the trade might fail. This one, I'm going to use the order condition. And let's say with this one, we're going to submit a market order. bid till canceled to close out of this, but only if Amazon falls to less than or equal to, what was our level? Was it 207? No, 205. So, type in 205. And I'm going to save that. Now, so here's our order. Get in for 250, exit for 375 with our gain, or exit if we fall down below 205 with our loss. Now, for right now, I'm just going to do, should we just do one contract? Let's dial this up. If we're in for 250 with a $250 maximum loss, let's say we're willing to do 10 of those. That's a $2,500 maximum loss. Let's make sure these exit orders match. We are ready to go. Let's click confirm and send. We're going to buy these verticals for 250, sell at 375, or sell if we fall below 205. Now remember, due to potentially wide markets or liquidity risks at the time of the activation, the stop order may be manually substituted with a limit order upon activation and working tail filled. And we just need to note that we've selected a weekly option series with a non-standard expiration date. Let's send that off. There are commissions to be paid here. I'm going to send that off. There we go. Guys, we've accomplished what we set out to do today. We walked through 5 steps, 5 key steps for planning and placing a long call vertical spread. I hope you enjoyed that discussion. If you haven't done this already, make sure that you subscribe to our Trader Talks channel. Follow Brent and me on X at Brent Morris CS, at Cameron May CS. Guys, I'm going to set you loose. Go enjoy the rest of our educational offerings for the day. We'll be following up on these trade in future webcasts. This is what we do on Thursdays. Hope you enjoyed the discussion. I will see you again next Thursday. I'll also see you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.